It seems to me that the SEC and the judge are in between a rock and a hard place. So the SEC told the court that the VERI Fair Fund was ready to close and that the final accounting was complete. Then came a new invoice. Then document 177. And now the SEC says that more invoices may be coming. RCB Fund Services, Holland Knight, Miller Kaplan, all after the so-called final accounting. So the question is simple. If there's still bills coming in that need to be paid from the residual, what exactly is final about the final accounting? So document 177 is the SEC's response to the defense's request for a pre-motion conference. The defense wanted to address the SEC's May 11th status report, the one saying that RCB Fund Services is submitting a new invoice that wasn't accounted for in the consolidated final accounting report. The defense argued that this mattered to the pending motion to terminate the Fair Fund and to the special master request. The SEC said no. They said that the May 11th status report is not a briefing, not a factual admission, and not relevant to the motion to terminate or the special master motion. Just notice of new fees incurred after the motion to terminate was filed. And according to the SEC, those fees can be addressed after the consolidated final accounting report is approved. The May 11th letter was already important. It said that RCB Fund Services submitted a new invoice on May 6, 2026. It also said that invoice was not accounted for in the consolidated final accounting report. And it said it covered work performed after the consolidated final accounting report was completed, including accounting reports prepared to comply with Judge Scanlon's December 2025 directive, compelling the SEC to produce quarterly accounting reports they said they already had, and now are asking for more time to create. Then document 177 added more. The SEC says Holland Knight and Miller Kaplan also plan to submit invoices after the consolidated final accounting report was fully executed. And if the court grants the SEC's motion to terminate, the SEC says it will file a motion to pay all outstanding invoices from the remaining Fair Fund money, then send whatever is left to the Treasury. So this is no longer just one invoice, it's a moving closeout. And if the deductions are not final, then the residual is not final.
This is a pretty good day for some peer-to-peer trading.
Now this did not start with document 177. Back in July of 2025, the defense was already challenging the accounting record. The SEC responded that there were no missing pages in the consolidated final accounting report. But the stronger point is not the missing pages. The stronger point is the record integrity. The SEC acknowledged that the CFAR pages were not continuous. It said that the report appeared to be complete, not audited, not transactions supported, not every liquidation traced, not every fee and tax payment supported, appeared complete. And document 132 added a footnote that matters. SEC counsel disclosed that she was not counsel of record when the CFAR was compiled or when the motion to terminate was served, and that her information was deduced from the SEC records and the case file. Now that is not court-tested accounting. That is a lawyer's inference. And the court is being asked to use that record to close a fair fund, discharge fiduciaries, pay vendors, and send money away to the Treasury. The SEC also relied on Holland Knight's belief that its quarterly reporting duty had been fulfilled. But a fiduciary's belief does not amend a court order. And now, months later, the SEC says more invoices are coming after the final accounting. Here is where the invoice issue gets serious. The final judgment required quarterly reports and accounting. But later, the SEC acknowledged that its quarterly reports filed from 2021 to 2024 did not include the required accountings. Judge Scanlon then compelled the SEC to file the missing quarterly accounting reports in December of 2025. This is when the SEC asked for more time to create them because they didn't actually have them. And now document 177 says that this new RFS invoice includes work preparing these quarterly accounting reports to comply with that directive. So the defense question is direct. Were these accountings already done, or were they just created later? Because if the SEC's agents previously represented that these reporting obligations were complete, and now the Fair Fund is being asked to pay new invoices for preparing the very accountings the court had to compel, then the court needs to see the details. Not summaries, not line items, but actual invoices. The time entries, the task descriptions, the rates, the prior payments, and a sworn certification that this new work does not duplicate work that was already billed, paid, or required under existing court order. Now, to be precise, the record does not yet prove double billing. You would actually need the invoices, time entries, payment history, and task descriptions to be able to prove that. But it absolutely raises a fee integrity red flag because we don't have those invoices. The court required reports and accountings for this reason. Holland Knight stopped reporting after it said it did not intend to file any more reports unless the court otherwise requested. The SEC moved to terminate the fund based on the consolidated final accounting reports. The defense challenged the accounting, and the court compelled the SEC to provide the missing accounting reports. The SEC now says that RFS billed for preparing those accounting reports. And Document 177 says Holland Knight and Miller Kaplan also plan post-CFAR invoices. That creates an obvious question. Why should the Fair Fund pay again for work that should have been done correctly the first time? Even if it's not technically double billing, the court still needs to ask if these new invoices is for new work or for corrective work done for prior non-compliance. This connects to a larger accounting problem. The defense argues that the consolidated final accounting report gives outputs without the full input trail. This is why they're asking for a special master. The court can see some distribution side math, but the defense says it can still not see the complete bridge. Frozen assets, liquidation records, sales price, sales dates, counterparties, capital gains, tax support, fees, invoices, residual. Again, this is why the defense is asking for a limited special master or a neutral forensic accountant. Because once the court approves the consolidated final accounting report and pays the additional invoices and sends the rest of the money to the Treasury, any errors becomes much more difficult to unwind. The defense fairness point is clear. When Reggie challenges a residual, the SEC says finality controls. But when the SEC wants to reduce the residual with more invoices, the process becomes more flexible. That is asymmetry. Before another dollar is paid, the SEC should have to prove that this work is new, necessary, authorized, reasonable, and not duplicative. Because if that work was already done, why are they billing for it again? And if it was not done, why are they asking the court to close the fund? The SEC says the accounting is final, but the invoices are still coming. A final accounting that keeps changing is not final. If I could throw my opinion in here for a second, it seems to me that they don't want Reggie to have money that's rightfully his. Thanks again for all the support, and I'll see you guys next time.